Each and every year we have FUD around the time of the Chinese New Year, set to take place on the 22nd of January, spanning to around the 24th, but from some websites it says that this may last up to 2 weeks in duration. Now typically what we see across this period is increased market volatility. Is that warranted or not? Let's have a look in this video. We're going to have a look at both the Chinese New Year outlook for the whole of the year and also the period for the Chinese New Year, this 22nd to 24th of January. So for fans of the Zodiac, 2023 sees the year of the rabbit. It's in fact the water rabbit this time round. Begins on January 22nd, and in Chinese culture, the rabbit is a symbol of longevity, peace, and prosperity. And 2023 is predicted to be a year of hope. Now recently I've seen a few tweets from GCR Classic here, one of the big time traders. I believe China and Asia in general will fuel the next run. He says it will take quite some time to melt Western cynicism towards the space, but the East is ascending and yearning to flex. You should be hanging out in WeChat. Many future pumps will be on coins none of your circle knows about. So two indices to look through here. We have the SSE composite, that is the Shanghai composite, and also the Hang Seng index here, both of which bottomed around this point on the chart, the 31st of October 2022, and have both seen some bullish recoveries here, mainly the Hang Seng going off like a rocket here. So the first thing I wanted to talk about was what is the kind of outlook for these indices going forward with China reopening after some very strict COVID policies. We've seen in recent weeks that the Chinese policies have been very favorable in terms of opening back up. Zero COVID seemingly waived, and many of their stocks doing very well here. Business has started ticking up once again, and with that we're seeing allocations from big money managers back into China, but not that much as yet. So listen to this clip from George Sun of BNP Paribas as to what he believes is going to happen for the Chinese stocks going forward and the potential for risk assets.
So you're saying stage one of this whole reopening play, pretty much priced in. What does stage two look like to you?
Well, I think stage two, we have to be a little bit cautious because from November to now, it's been such a big rally, in the equity markets, the FX markets, the credit markets, especially offshore, like the Hang Seng China Enterprise Index up 50% since November. But the onshore equity market, CSI 300, only up about 15%, only 15%. I think this shows some of the flows as well as the composition of the stock indices. But I think a lot of the big global real money asset managers who reduced their allocations to China, let's say second half of last year, they haven't come back in yet. So if they come back in, there could be another leg up actually later in the year. So just in the first 2 weeks of the year, we saw about $9 billion equivalent flow northbound in Stock Connect, compared to only $13 billion for all of last year. So if it continues at that pace, you can see where that could drive things up.
What do you make of just the macro backdrop now? It's almost like these two opposing forces, a China reopening and then a US and a Europe that's slowing down. How confident are you of those two things actually making some sort of impact this year?
I'm confident of one and not so much confident of the other one. So I'm pretty confident that the China reopening is happening. I think they've changed too many policies in the last 2 or 3 months, and the central government has said, economic growth is their priority for this year. So they're going full steam ahead at this point. The global one I'm a little less confident in because everything has been too perfect up until now in the beginning of the year. The warm winter in Europe, inflation coming down a little bit. So all this, and you see since just in the first 2 weeks of the year, equity indices in Europe are up almost 10%. Even the S&P is up 4% when everything should be recessionary at this point. So it doesn't feel quite right, actually. So it feels like there's a lot more room for the downside if anything disappoints going forward.
So one of the key points to pick up on is the fact he says that economic growth is now key for the Chinese economy, and they're trying to really prioritize that. With the reopening, you can see this on the chart, some massive green candles, very bullish posturing, and a V-shaped recovery from this kind of region in the summer of 2022. From the 31st of October bottom there, which potentially could be the market cycle bottom, listening to what George had to say, they're up 45% already. And what he sees happening is many of the asset allocators, hedge funds, etc., maybe Westerners, who have pulled their money out of China, really start to reinvest once again, maybe towards the second half of this year, which could see a second leg up here. Just as an eyeball across, you can see area of resistance 1, 2, and some serious traffic in here. Hence, there's a bit of a red candle here right now. But if this can get flipped into a support, I think that is bullish for these stock indices. Now, we know that Bitcoin bottomed here. This was Monday, the 21st of November, 2022. Bitcoin at 15.5 100K. Since then, we moved sideways, pretty much grinding up like $500 at a time, and then started to continue to consolidate. And then just after Christmas, we started to go off like a rocket into 2023. So as of recent, a lot has been made around the correlation between the S&P 500 and Bitcoin. But if China and Asia more broadly is the new basis from which a bull run will be sparked in the risk assets like Bitcoin and cryptocurrencies, well, is there a potential that the next major correlation to watch for is the Chinese indices versus Bitcoin? As you can see, this V-shaped recovery on the Hang Seng mimics that of BTC if you pull this out to the daily chart from around that 8th of November dip, exhibit A by here, and the formation of green candles for Bitcoin. We see the movement of the Hang Seng versus BTC. It starts to paint a similar picture. This will be something I just continue to monitor to see if there is correlation and to see whether it is in fact China and Asia more broadly that is max bidding on our beloved cryptos. But now let's talk about this article here from the Box Mining channel, a really interesting one. He does have his finger on the pulse in terms of Asian markets. So January 22nd to the 24th is the start of the Lunar New Year or Chinese New Year. And he says during this time, many Chinese over-the-counter services will be closed, leading to high crypto volatility. So we have 4 previous years, 2019 through to 2022 here. The pre-Chinese New Year high in 2019 was $3,492, and the low during that period was $3,398. Just a 2% move. That is nothing to get yourself out of bed over. And in my mind, that is a nothing burger in terms of volatility. Then in 2020, we saw the pre-Chinese New Year high of 9,124, and then the low during the period, 8,245, a 10% decrease. 2021 saw a total of an 8% decrease. Both of these seemingly decent discounts to get on Bitcoin. And then in 2022 from 38.5K down to 36.5K, a 5% drop. So in terms of an eyeball test there, I wouldn't say there's anything to really be worried about. This could just be a typical Tuesday for Bitcoin. But prior to this recent run up in price, we had seen a lot of muted volatility in the market. Whereas if there was 7-8% moves over a few day periods sparked by the lack of liquidity from Asia, then that would have made a difference. But in recent weeks, this really wouldn't be that triggering. But I definitely think this is a good thing to think about, increased volatility with a lot of traders and OCC desks stepping away for at least a 3-day period. This could mean much thinner order books. So in terms of a potential pullback across that period and some serious market manipulation, I think that's almost a guarantee. Now this article goes on, the period is a public holiday in China as many employees make the annual trip back to their hometowns, and with a population of 1.38 billion people, this represents the largest short-term migration in the world. All factories in China closed during this period, with operations frozen for up to 2 weeks as logistics companies and suppliers slowly open up. Chinese New Year is also celebrated in other Asian countries, Hong Kong, Singapore, and Korea. So there could be some widespread disruption across this whole period. In terms of China just recently opening up, this could actually be positive for inflation. Chinese-based inflation is probably something to keep your eyes on due to the fact there's going to be higher demand for oil, etc., and commodities generally if the Chinese economy is picking back up again. But as you can see, if we have like a 2-week down tool period, this could be delayed further on. So I think the bubble we're seeing here in January of 2023 could continue on, with this providing a bit of breathing space here. Trading volume also likely to go down. Data compiled by CoinDesk Research shows that Binance, Huobi, and OKX are the most popular crypto exchanges catering to Chinese customers. And volumes are likely to go down as this corroborates with another period in the year during October, the Golden Week, which is a 1-week celebration for National Day in China. When that takes place, volumes also do drop off significantly. So I do think this period is definitely one to manage risk. If you are using leverage of any sort, cascading liquidations could be easy to pick apart, and market makers can move the price around to liquidate people en masse. It's believed that market makers will actually be out of business for 3 to 5 days during this public holiday, and it states again they believe there will be more volatility and less liquidity across the markets. A reason given for the potential decline over that 3-day period is the fact people may cash out their cryptocurrencies to provide these red packets, these lucky symbols of prosperity given to the elderly and children, as this is seen as the one time of the year where giving cash is not taboo in China, so a bit of a cultural learning there. Then there's some insight here from some WeChat links that I didn't really want to open. And they say that the analysts believe there's going to be some optimism prior to the Chinese New Year, and that is certainly playing out here. Unemployment apparently increasing at the slowest rate since October 2020. People believe that this is a positive news story and that fears in the Chinese economy will start to ease. The general consensus among analysts on Weibo, China's social media platform, is that whilst the overall market is in state of shock, there is a sign of recovery. And with the recent pumps, it states here, there's definitely a growing euphoria in the Chinese crypto community, with some even suggesting that seasoned crypto traders should seize this opportunity to get rich during the Chinese New Year. So the Year of the Rabbit is about peace and prosperity, with individuals believing they're going to be a lot more lucky this year than the previous year. And that surely couldn't be that hard to beat, especially for the folks over in China who are locked into their homes. And so I think with the reopening of China more broadly, if there is to be this max bidding from Asia, well, then the potential increase in crypto prices across the board could well come from Chinese investors. But let me know your thoughts down below. Do you believe the Year of the Rabbit is prosperous for BTC and crypto more broadly? Hit me up down below, guys, and I'll see you in the next one. Goodbye.